Bitcoin's days are numbered. It may not survive if investors continue to only hodl, never using the Bitcoin network. Fortunately, today's guest has a solution, a development so massive, it might feel like this problem is solved for good. And if this project succeeds in unlocking native Bitcoin programming, BTC might just become the only programmable L1 that even matters. And it's all just months away, in fact, days away from being a possible reality. In this conversation, Matt, the CEO of the Arch Network, shares what Bitcoin DeFi will look like in 6 years, why Bitcoin native programming is finally possible, and the reason it's vital to BTC's survival, and why the Arch Network is on a mission to save your bags. Enjoy, and let us know if you agree. Matt is the CEO of the Arch Network, a project working to bring complete programmability to the Bitcoin network without sacrificing security, liquidity, or sovereign control. The Arch Network claims to be the only bridgeless execution platform that unlocks Bitcoin DeFi with Turing-complete smart contracts known as programs on the Bitcoin base layer. Let's get into it. Matt, excited to have you here. I'm going to ask you to give kind of a fifth grade level explanation of the Arch Network. But before we get into that, I'd really like to hear, in your mind, paint a picture for the audience. It's 5 to 6 years down the road, and the Arch Network has been a massive, massive success. Describe what that looks like for the common Bitcoin user and maybe even non-Bitcoin user.
That's a great question. I think that to know where we're going, I think it's helpful to look kind of backwards a bit and see how the landscape really evolved, the DeFi landscape on other programmable chains such as Ethereum and Solana over the last 5-6 years, right? Like before DeFi summer of 2020 that everyone remembers, because that was obviously quite a interesting time to be in the crypto industry. Is before that, years before that, obviously Ethereum ICO'd in 2016, 2017 time, when a lot of these blockchain ideas or distributed systems and use cases for these distributed systems were just simply that, just ideas. There were lots of teams that needed to continue building their products. There were lots of tooling and infrastructure that certainly needed to come into the picture so that the applications that are quite taken for granted today, obviously, with these incumbents like Uniswap, Aave, Curve, et cetera. There was quite a bit of growing pains for those applications to really start to form. And for users that kind of came in from the last cycle of DeFi summer of 2020 or the NFT wave of 2021, I think that they weren't around for a lot of the growing pains that these more programmable chains experienced.
Sure.
And that's where the Bitcoin ecosystem is today, right now. We are aggressively and quickly getting the infrastructure and tooling to a point that the broader developer community can now take this opportunity and run with it like they did in the Ethereum and Solana landscapes of years past. So, it's this moment right now where we can see some semblance of what's to come. There's, some swapping and some order books that exist on a peer-to-peer level that are servicing the yield maxis, which I'll touch on that in a minute. Like we obviously know about the laser eye maxis of the Bitcoin hardcore user that really advocates for just using Bitcoin as this this digital gold that cannot be censored in any type of way. So just hold and stack your Bitcoin in a cold storage wallet. That's kind of the views of the laser eye maxis, as we call them. And then now we're starting to see these more yield-friendly and PFP, NFT-friendly type of Bitcoin native user, which is only going to proliferate as the years go on and as the user experience gets better.
I was going to say, I joined the movement, if you will, in 2017, and I think your description of the maxis versus everything else is so apt. There are so many people that are just buy it, hold it, go away for 10 years, and just come back and be happy. While you saw all this proliferation of programmability and interesting experimentation happening on these other networks, I mean, a lot of people that maybe are newer will forget that Vitalik started off as a Bitcoiner and became frustrated with what he couldn't do on the Bitcoin network, and then started this other project. So, okay, so you're saying that if you think back to the story here, there was a lot of growing pains to get some of the great tooling that exists today on some of these other networks, where you're saying right now we're kind of at the starting point, maybe with some of those tools. Walk us through what you see, again, that 5 to 6 year picture. What does that look like that now that Arch has been successful from a tooling perspective, maybe, in user perspective? How does that come together in your mind?
I think, again, we can look at what's already happened before us, follow that exact playbook. everything that has existed in Ethereum or been developed in the Ethereum landscape is largely going to be tried in the Bitcoin network. And for obvious reasons, like the concept of DeFi and connecting, anonymous and not necessarily trusting individuals together to form these, decentralized and distributed forms of finance and other types of applications, of course, that leverage that self-sovereign money, I think is really the unlock here. And like you mentioned before, in Bitcoin early days, there was a void that Bitcoin created because there wasn't anything that you could really do with this programmable money. It was just use it, hold it, store it, or send it. That's the only way you can use it, really. But that was an intentional design choice made by the core contributors of Bitcoin to prioritize uptime and security over more expressive things and programmable things. So that gave Vitalik and the Ethereum ecosystem a way of kind of creating a wedge in and filling that void. But now with the implementation of Taproot and Ordinal theory, so these upgrades to Bitcoin that's happened over the last year or two, that's really what has enabled this newfound opportunity to then circle back to what Bitcoin was initially not focused on, more focused on that security component, which, by the way, was the right move at the time. Adding in all these other complexities and more programmable things certainly could have, compromised or brought in a bearish situation for Bitcoin if he chose to prioritize those things first before scaling the network in a way that it did. So it's so ultra decentralized and it's very, very safe, right? So that's probably the first order of things that you should prioritize when creating this digital form of money. But now, how do we actually take that and go to the next phase of growth for this ecosystem? And we have a lot to learn from with the Solana and Ethereum communities on how they were able to optimize for some of these more programmable things and create the tooling and infrastructure needed to bring that next wave of distributed applications.
So would you say it's an accurate statement to say in 5 to 6 years you see a Aave, you basically see DEXs or you see AMMs, you see all of the existing tooling that you see that's on Ethereum and Solana, you see Bitcoin native versions and they're operating with similar or higher amounts of capital? Is that kind of what you would see? Okay, that's kind of a win state in your mind in the next 5 to 6 years.
Yeah, I think you're going to see a fully developed and mature DeFi ecosystem that has a lot of similar, and things like apps that we are more familiar with on these other programmable chains like Ethereum, but you're going to see it with more Bitcoin native assets, where users have certainly come to love holding Bitcoin, and now they love to trade these more fungible tokens that are native to Bitcoin, like Runes and BRC20. Obviously, Ordinals being a more associated as a more premium NFT asset because it's not stored on IPFS, it's stored on the actual blockchain. It's quite literally forever. So there's a lot of exciting pieces there that we like. What we don't like is
if this conversation makes you want to invest much, much more, but you're nervous about the right time to buy or managing wild volatility, maybe it's time to consider letting the super smart AI J trade for you. What does an AI trading bot using years of market history and 1 trillion data points know about the market that you don't? Well, click the link to find out.
The fact that Bitcoin scripting language is so limited, there's not that many accomplished developers who are used to programming with this, and it just doesn't do Turing complete programmability in the way that we would come to expect after participating in Ethereum and Solana lands over the past few years. So how do we bring the necessary infrastructural elements into the picture that allows for these types of activities and user behaviors to really become native to Bitcoin? That's really what Arch is set out to do. So
I'm curious, there's a lot there to unpack that's really, I guess, interesting in the back of my head because there's so much competition. Like you see it just today. Is Solana gonna cross Ethereum's market cap? Is it going to take over all of its transactional volume? Years ago, we would always be talking about, is Ethereum going to flip Bitcoin? Assuming you get there, right? Assuming that Arch is able to help with the establishment of those tools, how do you see that playing out? Do you see a lot of flight of capital from these other L1s coming into Bitcoin? Do you see this maybe opening up Bitcoin to a much broader audience that's maybe not even native to crypto? How do you envision that?
But first and foremost, I think that Bitcoin is the asset that just like globally speaking, we all are involved in various elements of globalization of technology, and certainly a user in the US does not have the same types of priorities as maybe a user in Egypt, for example. And there's a lot that can be learn from in some of these more, volatile markets where, people, their families' money is quite literally at risk because you can't trust, this local government or financial infrastructure to not screw with your money, not print more and drive your family's dollars into a death spiral of inflation. And I think that Bitcoin is sort of that safe harbor for a lot of these people throughout the world. Even without how prevalent Ethereum and Solana has become over the last, half decade, they're not even coming close to the perceived safety and stability that is perceived when you're dealing with and holding Bitcoin. So I think that creating a whole economy on-chain and off-chain, leveraging Bitcoin, the asset, is certainly ripe for disruption. And then also using Bitcoin as the technology rails as well is a whole nother opportunity as well to build more programmable things that can, more closely and in a more native way utilize those Bitcoin native assets. So I think that that's where we're at today. There's a proliferation of Bitcoin native assets, which is certainly the catalyst or the driver to wanting to create more Bitcoin native programmability. And I think that a good data point is the emergence of Stacks, right? Like a couple of years ago, Stacks was still focused on the exact same problem that they are today, which is how do we unlock DeFi programmability on Bitcoin? But the thing is that there were no developers, there are no users interested in actually participating in that DeFi construct on Bitcoin. And now we have obviously this, it's the surge of other layer 2 scaling solutions. Stacks is starting to get a lot more TVL and users of their DeFi applications. So I think that is a proof that there are people that want to concentrate on sources of yield for their Bitcoin or trade these more Bitcoin native assets as opposed to, taking them elsewhere, bridging them to EVM or bridging them to Solana, for example.
Well, I definitely want to get into that in a moment, this notion of having to bridge, the fact that Arch is really focused on a bridgeless solution because custody as part of the ethos of Bitcoin is such a critical factor. If you're ever in discussion groups, in fact, I would say that's a lot of why legacy Bitcoiners are so skeptical at times of DeFi because they're worried about the custody relationship. Some of them may be more about this idea of bearer assets and who actually owns some of that risk, but that's definitely something I want to get into. But I guess a different question that seems more obvious that I still think needs to be asked: what drew you to Bitcoin? What made you see this asset the way you do? I mean, so many developers. We mentioned Vitalik at the top of the conversation. Said, listen, I like Bitcoin, but it's got limitations, and I'm going to start a new chain where I can really build, where I can put all this in. And a lot of developers have made the same choice. Said, hey, Bitcoin may be fine. It's got its use case. Let's focus programmability somewhere else. Why did you say, no, I'm going to do this on Bitcoin?
Well, first, I've definitely dabbled in Ethereum and Solana landscapes for several years. But the reason why, I chose to go back to Bitcoin is this is where I started. I think a lot of crypto investors and builders have the same exact, story or sentiment here is that, Bitcoin was our first love. It was what we chose to dabble with in whatever way, whether it was mining or trading or whatever. Back in I think it was 2012 or 2013 when I really started mining Bitcoin. And, because I had a friend that just, told me, hey, one day this internet asset's going to be worth $100,000 each coin. And at the time it was like $7. So, I was naturally inclined to dive deep and try to become an expert as much as I can back in those days. But like you mentioned, and Vitalik ultimately, made that position or thesis, which is like, there just isn't really much I can do here. I only have a certain amount of money as a young entrepreneur. I could only dump so much into this internet gold. And, I was day trading like 20 to 50 coins at a time, per transaction just to make like, 20 to $50 a trade. Back in 2012, like that was all I could really do, days of bit instant, really. Like I could sell the coins that I was mining. I could speculate a little further on the price volatility, and that was generally it. But then, the ICO days of 2016, 2017 came, and all of a sudden it was exciting because now you have like new types of applications that can be built leveraging this, this blockchain technology. So, I spent the majority of my crypto, background or history in those 2016 through 2021 days of really just grinding it out in the DeFi and ICO, evaluating every different project, on the merits of the idea, as well as, how likely I thought that the team was able to execute. And it did quite well over those years. But it wasn't until this past year, like maybe, March-ish, when there was Ordinals being spreadsheet traded amongst users. Like there wasn't any infrastructure to support this yet, but it was clearly exciting. And it was clearly this new watershed moment for Bitcoin as in general, with this whole ordinal theory from Ordinals. Casey created that. And then of course the Taproot upgrade of 2021, I think is when it came out, that allows you to put arbitrary data on Bitcoin for the first time ever. I think that was like this new aha moment for me, because I've seen all these other ecosystems and how they've progressed. Ethereum obviously was the leader in programmability, but then Solana found a more efficient way as Ethereum was becoming bottlenecked, and having this whole modular versus monolithic ecosystem thesis. Watching how it played out, I kind of formed a thesis around how Bitcoin could ultimately scale. And, I think that, here at Arch, we're much more aligned with Stacks once again, in the sense that, we want to be doing lots of reading and writing to and from Bitcoin, as opposed to allowing the EVM to be that execution environment to scale Bitcoin. So, when I say we, myself and my co-founder, Amin, we kind of really aligned on this counter narrative, which is, I don't think all of these layer twos are necessarily where we start, maybe where we end up, but we need to focus on bringing the core infrastructure elements to bring programmability to Bitcoin, as opposed to imposing this, the baggage from Ethereum and how they scaled their bottleneck problem, and figuring it out from at the bottom of the stack, figuring out what can we bring and what is it lacking, what is Bitcoin lacking to where it's not able to do these things more natively. And that's generally how we approached it.
So Matt, maybe this is a controversial question. If ordinal theory had never been invented or put out there, would you still be dabbling in the other dark arts of the rest of the ecosystem?
It's a good question. I think, most likely, right? I think like Ordinals really is what kicked off this whole new wave in the Bitcoin ecosystem for wanting to bring more programmable things. The Solana ecosystem right now, the vibes are really, really high for a lot of good reasons, right? They optimize for some really good things that I think that maybe Ethereum chose not to optimize for, and now the Solana ecosystem are certainly getting a lot of positive attention. So taking what we've learned in both ecosystems, I want to say we again, myself and my co-founder, who's extremely competent low-level system design engineer with respect to design. And you can see that in some of the choices that we've made and some of the explicit trade-offs on how we built our VM and how we built some of the Frost and Rose multi-sigs as well, which provides that conditional execution dynamic that really you need in order to do Turing complete smart contracts. I think, there's a lot of, re-education that needs to happen, because a lot of users, when they hear the word multi-sig, they just automatically assume it's just like 2 of 3 multi-sig. That's centralized and sort of the source of this entire programmable chain that uses EVM to do the state transitions of that. Without diving too much into the weeds, I think that, we really aligned on the sense that we need to build something for Bitcoin, as opposed to using something in a, crowbarring it together type of thing.
Well, yeah, and I definitely want to get into the problems that as you see them. You just mentioned, you highlighted a few, right? That one of them being this notion of L2s and their role versus writing directly to Bitcoin. But I guess before we get in there, I think you're making the case, and your thesis is that the programmability, this 5 to 6 years down the road, Arch is successful, and the ecosystem on Bitcoin looks in many ways similar, right, in terms of tooling that you see for the ecosystems like Ethereum and Solana that have already gotten there, right, with sort of these DeFi capabilities, but it's perhaps even more robust, right, because of what you've been able to create. I guess, where do you think DeFi sits in the success of Bitcoin moving forward? And I'll say it another way. Do you think Bitcoin can continue to serve its role and grow and gain mass adoption without the DeFi tooling that you're working on along with some of these other projects?
To be honest, and this is kind of a hot take, like we think that DeFi and doing more things on chain with Bitcoin is absolutely necessary to really cement and protect the long-term sustainability of Bitcoin security budget. At the end of the day, the miners need to be profitable. They're the ones that are securing, the Bitcoin network with proof of work, and they've got hard costs that have to be considered when it comes to their businesses. At the end of the day, these are commercial businesses that need to make money and profit over time. So as blocks get harder and harder to solve because of the coefficient of difficulty, that is in the mining, script, so that the less and less Bitcoins can ultimately be mined over the long term, that is concerning as well. So as, Bitcoin, starts to plateau a little bit in terms of appreciation and its price, and you have to look at other ways that can drive revenue back to the miners. And the only way that really happens is more on-chain activity. The blocks need to become more expensive as people fight for that inclusion of block space and being, included from the mempool into the block. So that will scale fees for the miners. But for the validators in the Solana ecosystem, you can ask them what's more, enticing. Is it the gas fees and emissions from the on-chain activity, or is it the MEV or transactional ordering? And I think 90% of their revenue currently is coming from MEV as opposed to the former, which certainly may have been the initial catalyst for rewarding the validators of the Solana ecosystem, but really is rewarding now, and why they're making so much money is due to that MEV opportunity. So
just to double down on that point, could you just explain for the audience and maybe aren't familiar with the MEV revenue? You just gave out sort of the two sources of revenue that are coming in for these validators. Can you just break down a little bit more on the MEV, what that would actually mean, and potentially challenges that could create for the ecosystem?
Yeah, sure. So we've sort of seen a taste of what it can look like in the Bitcoin type of way, what it means for bribing the network and prioritizing certain transactions over others through RBF, right? This is replaced by fee. This has been largely utilized in just the Ordinals trading dynamic thus far, because basically, we have 10-minute blocks, which is obviously a long time to see what's happening in the mempool. And if there's an asset that has, a decent amount of delta or perceived profit from another user, they can essentially bribe miners to take their transaction over the other ones that may or may not have happened first. And since it takes 10 minutes for that block to be finalized, the one with the highest fee bribed to the network can ultimately, take that confirmation and be finalized within the block. So basically what MEV is, or maximum extractable value, is basically like the potential profit that could be made by manipulating transactions in a blockchain. Like, so in Solana, MEV is a revenue stream for validators who are responsible for creating the blocks, ordering those transactions. So if there's an opportunity to gain more money by prioritizing one transaction over another, the nodes are optimized, so the signers of that network are optimized to prioritize that one. That brings more and more revenue.
Would you say, in your opinion, that's a good source or toxic source or neutral source of revenue versus just pure volume usage of the network?
Well, with Bitcoin, you have 4 megabytes worth of block space, and that's the hard cap. Like, there's, when we get to the point where there's so much on-chain activity so that we can't fit, everything that wants to be executed or extracted data-wise on Bitcoin, there's going to have to be a situation where whoever pays the highest price is going to be confirmed in the block. Like, that's just how things are going to optimize for the long term. Is it's just better for the business or the blockchain in general. So I don't necessarily think it's bad. So there are some maxis on the Bitcoin side who do not want to see MEV happen, but I think if you're paying attention to what's happening on Solana, it naturally allows for the gas fees or the fees to use the network. It drives those fees down, which is a better user experience for the end user. And again, it's scaling the security budget and getting the miners paid for what they're doing to secure the network. I think right now, like, the cost to mine a block is around $72,000, but cost of Bitcoin is $64,000. So like, that means at today's price, it costs more to produce a block for the miners than is what their reward is. That's not good, because at the end of the day, if the miners say like, hey, we've been in the red too long, we're just not going to continue to do this, then that's when we get a really bearish situation for Bitcoin and probably the crypto landscape as a whole, because kind of everything follows Bitcoin.
Yeah. So so something that wasn't mentioned in terms of the win state 5 to 6 years on, it's that the miners have a healthy ecosystem that's supporting them as well, right? So the balance of the users and the network and the miners all coming together, the success isn't just in the amount of value that's now accrued to the Bitcoin network, but really just the fact that it has a sustainable future.
Correct. Absolutely. I think, like, if we're not focused on how the miners make money long term, then it can get quite dicey if that's the future, that we're all kind of just locking our Bitcoin in cold storage and not using it on chain.
Yeah, and I find that really interesting and actually compelling when you say that, because as someone who's sort of sit on the sidelines, not as as a non-developer, I found a lot of those arguments kind of tone deaf. It's like, this is digital gold, but then we're gonna carry with it all the limitations of you can't do anything with your block of gold. And I'm thinking, well, that seems rather odd when we're digital. So the fact that you're trying to solve that, I think, is very encouraging. So obviously, I'm pro. I'm pro. Make some changes, but let's actually get into the chief problems that you're trying to address. We already talked about the fact other developers went over to other L1s like Vitalik to create Ethereum because there are limitations with the way that Bitcoin has been constructed. And because of that, you have to be very creative. And Ordinal Theory opened up the design space, if you will. And it looks like you guys are trying to move forward with some of the problems you're trying to solve. So could you break down, you've done a great job. I mentioned offline, like, if you haven't already read Arch's white paper, I guess I'll call it a white paper. I think that's the right term for it. It's got great documentation. It's a great read. I think you guys have really just simplified a lot of very heavy concepts. So I would go check that out. But Matt, from your perspective, what's the chief problem you guys are trying to address?
I think, simply put, the user experience challenges that are faced when someone wants to use one of these DeFi applications, or layer twos in general. I think that it's largely taking the UX out of consideration, and that shouldn't happen, because at the end of the day, the users of these protocols need to, and their expectations need to be considered. So every single solution that we saw, when Amin and I joined the Bitcoin Startup Lab, everyone was either planning on building an L2 or trying to choose which L2 to build on, and virtually every single solution that existed was some EVM roll up, copy pasted, that they claims, EVM was going to scale Bitcoin. And we just unequivocally thought that was the wrong approach. So we got to work on, getting really down low to the code and designing something that we thought made more sense for the user, depending on where they fall on the trust spectrum, right? So there's going to be some users that are willing to take on more trust assumptions than others because they're expecting either more performance or yield opportunities. And then on the other side of the coin, you have, these other users that do want to play around in DeFi. They're not necessarily, maxis and cold storage only type of users, but they definitely do care about their self-sovereignty. They don't necessarily want to give up their control of their assets into a bridge or locking those Bitcoin into a bridge that could be minted on a new destination chain.
Hey Matt, I just want to break in there again. We've got a lot of people in this audience. The knowledge base is going to be very broad. Maybe you could just give a 30-second description. When you say a bridge, what exactly is that? Why that may not be consistent with, or that requires certain trust assumptions, and why some people may not be comfortable with it?
Sure. Yeah. So I think we all know wrapped Bitcoin, its role in the Ethereum DeFi ecosystem, with MakerDAO and Aave, Curve, and it's a largely utilized asset in those ecosystems. But the way that you ultimately get your Bitcoin over to Ethereum land is you basically have to interact with this thing called a bridge. What happens when you interact with a bridge is you deposit your Bitcoin into this bridge entity's wallet, this multi-sig that they control. Once they determine that you have made that deposit, they will then mint a totally new asset on Ethereum or whichever destination chain that we're trying to bridge to. So this is not a Bitcoin. This is a ERC20 representation of Bitcoin. And that gets minted after you lock your Bitcoin inside of this multi-sig controlled by the bridge. So at this point in time, you have no control over your Bitcoin. You will have control over this wrapped Bitcoin, which is this Ethereum token representing one Bitcoin, on the Ethereum chain, which can then be utilized in DeFi and so on and so forth. So, generally speaking, that's how a bridge operates. Now, historically speaking, this is probably the biggest, point of exploit risk and vulnerabilities in the entire crypto ecosystem. You could go back and find exploits as large as $320 million in the Wormhole exploit. There's been a couple exploits in bridges this year, the Bitcoin ecosystem already. So, and by the way, this isn't a Bitcoin problem specifically. It's just a bridging problem because naturally blockchains don't communicate to one another, right? Ethereum does not communicate with Bitcoin. Ethereum doesn't also communicate with Solana. So if you want to bridge an asset from Ethereum to Solana, the same type of dynamic has to occur. You lock your Ethereum into a bridge entity, and they'll mint an SPL token on the side that represents that.
Right. And just to highlight there, I think the bridge side of it, the custodian that's holding your Bitcoin in that that then mints you that other token, right? The wrapped Bitcoin. That's a key. I mean, you've got the risks that you just mentioned. You've got exploits that happen. There's questions about. I think just how much, even if an exploit doesn't happen, does something else happen and you can't get your Bitcoin back? So it's I guess it's natively or it's inherently problematic for those who want to be able to retain their coin.
It's true. Yeah. And you can have total faith and confidence in that network. Like Ethereum, I'm not going to argue that Ethereum is not safe. I think like proof of stake has had plenty of time to solidify itself as a safe mechanism to make sure that there's hard economic security when securing a network. And having that slashing risk really prevents any malicious actors to try to take over a network. So I think that saying Ethereum isn't safe is definitely not true. What is not safe is necessarily this bridge entity, because that's not Ethereum. You're not trusting Ethereum when you trust a bridge. You're trusting both Ethereum and the bridge. So Ethereum could be safe, but the bridge could be not safe, and you can still, lose your assets. So there's a lot of faith that people put into bridge operators for a lot of reasons, not mismanaging the assets being, the majority of that concern.
All right, so I have to apologize because I think I took you on the rabbit hole down the bridge side of it for the audience, but we were talking about the problems that you guys see as the chief ones. You talked about the user experience kind of being there and realizing that you wanted to then go down and look more at the code and get even closer to the code to look at possible opportunities to be able to solve that problem. But that being kind of the key problem that you guys are looking at.
Yep. Yeah, I mean, like you said, the lower down to the code, the lower down to the stack that you can go, the more flexibility and the more concessions you can make to a particular, design. And obviously, the higher up you go, the less flexibility that you have. So I would call the higher up version would be sort of these lazier implementations of EVM copy paste rollups that claim that they're going to use some implementation of BitVM to get their data back to Bitcoin. Now, we do things differently because we constructed and built a VM from the ground up. It's not the EVM, it's not the SVM, it's not any other VM instance that may be utilized in other programmable chains. We built this from the ground up because we knew that Bitcoin has these things called UTXOs, which are very different in how virtually all other blockchains generally work. You have Cardano, you have Doge, and Bitcoin, who are on the UTXO, sort of design. But virtually everybody else, everyone in the programmability design space are all working with the account model. And for the people at home who, maybe don't know the nuances of both, I make the comparison of the account model as like using, a debit card at the point of sale, where it takes exactly the amount that you need for the purchase out of your bank account, and then it just deducts that from your balance inside of your bank account. UTXOs is like going up to the window paying with a $20 bill in cash. Like there's going to be change unless you buy exactly the right amount of exactly $20, which is probably never the case. If it's $19.22, you're going to get back a bunch of clunky change in your pocket, which represents what's left over. So using cash is obviously a lot clunkier when building things like internet applications, which you can't really use cash for at all, or different things that want to optimize for more efficiency. Obviously, these digital forms of payment using debit cards is much more conducive for that. So that's kind of a loose comparison as UTXOs versus account model. But
I love that comparison though, and it makes me think. I think that the one of the sentences or the subheadline for the Bitcoin white paper, a peer-to-peer cash network, if I'm not mistaken, I think there's somewhere in there that's in the first 100 words.
Yep.
People then are asking well, where's the cash part of it? And you just mentioned it. The accounting model is based on a cash setup.
That's right. These UTXOs are more input-output based, meaning if I have let's make the math simple. If I have one Bitcoin, I only have one UTXO in my wallet that reflects that Bitcoin, unless I explicitly want to pay to split those UTXOs, which it can happen, but there's no reason why the user would want to do that. Nobody wants to pay money to split a $20 bill into two $10 bills. That's kind of a waste. So essentially, you have to make considerations to these clunky UTXOs when building, programmability infrastructure and design, right? Because that's what Bitcoin takes into consideration. Bitcoin doesn't do method of accounts as these things called UTXOs. So Starting with an account-based VM is really a non-starter if you're really trying to build something that is native for Bitcoin, because it just doesn't handle these things, right?
Yeah, and that's something that's one of the. So you have this UX problem that you're talking about, which is which a lot of it's part of that bridging element that you discussed. You talked about the virtual machines that would be doing some of this programming or processing the programs that are based on maybe account models versus the UTXO model, which is native to Bitcoin. I think some of the other points that you mentioned in your white paper, you talk about inability to create native fungible tokens. I think maybe there's some other comments about standards, and then you have this fragmentation of liquidity. Is that kind of a good summation of some of the challenges you guys are looking at?
Yeah, I mean, if you look at every single layer 2 that exists as like an island, and the idea of being able to hop from island to island, like is kind of inconvenient if we're thinking about it in terms of like Ethereum or Solana, right? Like you have your balance in the account model of the VM, your state is all managed by that. And you don't necessarily need to deal with all these fragmented applications or protocols. Like, the ERC 1155 and ERC 20s, they have an ability to communicate with one another. They are not fragments. With respect to BRC 20 and runes, they do not communicate with one another because they use different indexers. So like, there's a lot of fragmentation that exists both in liquidity and state that is not really conducive for creating this virtuous flywheel for an entire ecosystem. And that's something else that we're focused on is, not further fragmenting Bitcoin by continuing to create more meta protocols, but telling those meta protocols and those other layer 2s and rollups and app chains to just build on our infrastructure, use our verifier network to manage state. And then you have just by default interoperability amongst each other. So we can do cross meta protocol swaps, like swapping dog for Ordi, meaning, runes for BRC20 and any other meta protocol that exists, whether it's SRC or ARC, doesn't really matter. All of it's kind of UTXO based, and we can handle it.
Is that, and I imagine a lot of people, regardless of whatever project they're working on, they may say, yes, we're going to be the winners. But in your 5 to 6 year vision, do you see multiple types of arch networks out there, or do you see, because of the benefits of having something that is UTXO based, solving for the custody problem, do you really see that arch network becomes the dominant force for programmability in the future?
I mean, we sort of like to think so, right? That's what we're set out to do. And the more state liquidity that we can aggregate into our system, the better the user experience, the better interoperability that exists amongst other meta protocols and other apps and layer 2s who may want to make certain concessions for some user experience, but they don't want to isolate themselves from everything else that's going on in the network. And I think that's what Arch generally represents is you have this construct that can be utilized for safekeeping of the state and aggregating that state together so that we have less fragmentation. And in our opinion, that's the major hindrance right now in the growth of this ecosystem is we've got 50 plus layer 2s, all basically trying to get you to deposit, your liquidity into each respective multi-sig and how those state ultimately are shared amongst them. That requires additional tooling and infrastructure like chain abstraction and, some of these mirrored state or interoperability protocols, which generally aren't necessarily needed. They're more redundant if we just had those layer 2s building or those rollups building on the Arch VM and verifier network.
Well, maybe explore that a little bit further for the audience. So if I think about sort of your road to success, the road to that win state, you've already created the primitives or the elements of the primitives that would go into your actual design. I know we haven't gotten into that too deep. I know, again, I'm going to reference the white paper as a place to do some of that. But you have sort of the core design of what you're trying to do. In your mind, sitting there as the CEO looking at how to get to that win state, is it about getting the developers to migrate from those other L2s? Is it getting the other L2 CEOs to kind of go, yeah, we get it, and let's put our backing behind it? Is it more about a viral app that kind of comes out from the tooling? How do you see yourselves being able to create the success that really does aggregate that liquidity to Arch?
I think it's a mixture of all three that you mentioned, which are pretty comprehensive from a layer 1 playbook per se, or even a layer 2 playbook like Blast. Number one, you need a viral app that everyone wants to use. Like for Blast example, Fantasy Top really drove a lot of the excitement and usage of that chain. And then that really is what drove the incentives and points campaign, which we will also have for users to then go out in the ecosystem and see okay, what other types of applications can I play around with in Blast land? And that's definitely something that we're focused on. We definitely have some viral apps that we're working on that should be quite successful and getting, a lot of excitement and activity on Arch as it starts out and then continues to just bootstrap and scale its community from there. The other one that you mentioned is how do we convince the projects to move up to Arch from these layer twos? And I think that is currently happening. That is happening right now because I think for the greater majority of application developers who launched this year on some EVM compatible layer two, because it was easier to do so. It was easier to fork an Aave or Uniswap contract and copy and paste that contract into this new layer two. They're finding it quite difficult to achieve a meaningful amount of TVL in these networks to have a good enough addressable market to scale their application. So there's only $200 million on one of these L2s of addressable market. You can't really build a stable coin. You can't really build a DEX and a borrowing lending ecosystem around 200 million. You kind of need billions of addressable market to really build an ecosystem out. So I think that those developers who, quite frankly, found it easier to deploy on these EVM L2s than Arch because we are a little bit closer to Bitcoin, maybe not a little bit, a lot of it. We are a Rust programming language, which has some advantages when it comes to programming for Bitcoin. And we use these UTXOs and the transaction flow. I think that is a bigger challenge and more friction up front for these developers. But, starting to realize that if this is going to be the only way that they can actually get meaningful amount of liquidity, it might be worth it for them to deal with those growing pains. That's kind of where we're at today. So that would be the second dynamic. And the third that you mentioned is trying to convince the CEOs of these layer twos to say, hey, look, you can build your roll up on Arch. That's probably the third thing that we'll focus on. But for now, that roll up as a service is not really the narrative that we're working on. But of course, is something that we'll allow and certainly encourage as time goes on.
Yeah, and I wanted to point out a couple of numbers that I had in preparing for our discussion. I was looking at Wrap Bitcoin, and I think these numbers came from DeFi Llama. I saw about $10 billion is the number that I found in Wrap Bitcoin, which is sizable. And then I was thinking back, I was having a conversation with some other people offline about sort of the demand for yield-based products for Bitcoin. You go back to some of the centralized solutions, which are now defunct, but Celsius at some point had $12 billion. I was reading an AUM for related to Bitcoin, and you had BlockFi. You had these other solutions that were doing something like this. So I think that speaks to there's demand for it, but then also what you were pointing out was that you need to have enough of that TVL invested to have enough traction to then get the flywheel going.
Yep, that's right. Yeah, and going back to the biggest point of friction when it comes to especially Bitcoin users is that fear of bridging. Right? If you're forcing the user to bridge first, doesn't matter how exciting the DeFi landscape gets on the other side of that bridge. Most users in the Bitcoin ecosystem are not likely to do that. And going back to your data point of Wrap Bitcoin to Ethereum, 10 billion out of 1.3 trillion is less than 1%, right? So thinking that we're going to convince native Bitcoin users to bridge to not even a mature DeFi ecosystem, which Ethereum certainly is, because you have Aave, Uniswap, Curve, lots of other borrow and lending applications like Arcade DAO and NFTFi, et cetera. I would have an easier time believing that we can convince Bitcoin users to bridge over there where there is lots of stuff going on because they've had 4 or 5 years of development and growth in that DeFi landscape, and asking them to bridge to an EVM compatible layer 2 where these are all new and nascent forks of what's already come before on Ethereum. So that's the dynamic today is what's worse? They're both bad, but there's probably a worse. And that's where the friction really lies with getting Bitcoin holders to actually participate. And of course, that's going to continue to change over time with the emergence of, elements like Arch. Stacks as well are making lots of innovations with regards to how you essentially deposit or stake your Bitcoin into this wrapped SBTC product. So like we've seen before, I think lots of centralized entities, like you mentioned, Celsius, BitGo with the wrapped Bitcoin product, they're much more centralized. But again, I think it's all about meeting the users where they are on the trust spectrum, not necessarily imposing one type of way. So CBTC from Coinbase came out with their version of wrapped Bitcoin that can be utilized on Base. I think that for a lot of users, that's an attractive product because they probably own Bitcoin in Coinbase. They know who to do if Coinbase goes down or whatever, FDIC insured, good user experience.
I'm sorry. I know I'm kind of giggling or laughing in the background. I'm thinking, here is someone building for the audience rather than telling them how to operate. It just sounds so unmaxy of you. But I think it's great. I mean, it's a fresh perspective for those of us who have been around Bitcoin for a long time. Obviously, you've been in the scene even longer than I have. But for the time I've spent here, this is the way, for the highway, right? Basically, get off the train if you don't like it. I like hearing that perspective. Okay, so there's a couple other questions I want to do here, because it's a broad space that's happening right now. It's this kind of Cambrian explosion. I like to think of what's happening from a development perspective. A lot of what you see, if you're just like on CT, maybe not in the chat rooms, is a discussion around OpCat. And your programming, your I guess, do you call it a protocol? I guess you call it a network. Is that the best description?
Yeah, it's a network, or global, like a state machine is really what the construct is. But at the end of the day, we're building an ecosystem or a network.
Okay, and so you point out on your documentation, you don't require any upgrades to work on this today. Whereas but there's this discussion of OpCat and the fact that would really open up the design space even further. What's your perspective there? I mean, has Bitcoin evolved enough so that you can do it? I mean, you're basically saying, hey, we have a solution here. It's ready to go. We don't need to do more development. Would OpCat, and maybe you can explain a little bit what that means for the audience, would that open up new design space for Arch Network, or would that create more risks than it's worth? What's your perspective on that? And maybe you could just start, like I said, with just a quick descriptor of what OpCat is for the audience.
Yeah, so I'm not nearly as well versed in the OpCat narrative as others may be. I think that if you look at fractal ecosystem right now, there's lots of innovation or lots of testing on OpCat and how we can actually utilize this for token standards and swaps and minting tokens and things of that nature. But generally speaking, it's just it's a Bitcoin upgrade that would give the blockchain the ability to support some elements of a smart contract similar to Ethereum. OpCat was originally an opcode in Bitcoin, but it was disabled, for security reasons. And now we're kind of revisiting this now that we've, progressed a certain amount. And essentially how I understand it is you're able to sort of this is what the cat goes in, concatenate data together and chain these states together in a way that allows Bitcoin, the network, to actually validate its heaps. So, with respect to what's happening on Fractal right now, I think that, there are some really nice things that have come out of it, like the Cat 20 standard, which is starting to get a lot of attention, which has like these pre-built, functions utilizing OpCat, which, will be, used probably if it ever gets forked into the layer one. There are some like limitations that OpCat brings, and this is me kind of regurgitating some of the concerns that my co-founder Amin, who's much better with system design and understands a little bit better of the issues that can arise. But I think state concurrency issues that plagued chains like Cardano are going to become relevant with building applications around OpCat. There's other issues like if you decide to chain these states together so that you can fit them inside of a block. There's only like 25 states that can be chained together. As long as they're not overlapping, of course. But if any one of those transactions fails or the UTXOs get double spent in that chain of chained states, the entire chain or everything that happens after that transaction would be basically would fail as well. So there are some things that we still think, as far as a user experience issue, there are challenges, and it's definitely not a silver bullet or a magic bullet that's going to just all of a sudden bring Ethereum programmability to Bitcoin. That's definitely not going to happen. It'll unlock certain things, but not all things. And that's where, a VM like Arch is really meant for, where we can do the other complex computations that OpCat is not necessarily able to do. But trustless bridging into systems like Arch, of course, create a better experience for the end user as well.
So maybe you can use that as a stepping off point, right? So you guys are kind of ready to go. Again, you're not the OpCat kind of expert, but I think what you would argue, correct me if I'm wrong, you guys have a solution that's already ready to go to develop a lot of the capabilities that you'd want to create that vision, that 5 to 6 year vision, right?
That's right.
With the tooling. But I guess maybe leap off from there and talk just at a high level. You've got this virtual machine, you've got the verifying network, you've got the signature scheme. Those come together to create it. What would that be from a user experience? I mean, rather than from a technical point of view, which I think obviously you could get into, but I guess from a user experience, how would they actually work with the Arch network? Would they know it's there? Would they not know it's there? Would it just be working in the background? What's your vision for that?
Yeah, it's kind of in the background, right? It's totally abstracted away from the user, so that they don't necessarily have to like go and deposit into the network, and then they can go and explore the ecosystem and what they can do with that deposit. It's really about interacting with whichever application that they were planning on using. So let's say we're going up to a DEX like Saturn, for example. Saturn was the first ever order book on Bitcoin to trade BRC20s, and they're going to have this AMM type of swap on Arch. When the user goes to Saturn's website and they, just like you would go to Uniswap, you don't necessarily like indicate that you want to deposit into Ethereum so that you can go to Uniswap. You just walk up to Uniswap and then up pops a MetaMask transaction or whichever Ethereum wallet that you use. You sign that transaction, really just all the magic happens on the back end. So generally speaking, from a user experience standpoint, they're just interacting with the dApps, they're interacting with their Bitcoin wallets, and that's all they're really doing. And of course, we'll have block explorers and things where they can see what's going on behind the scenes if they want to, just like an Etherscan, but for Arch network, which takes into account, once again, more UTXO type of Bitcoin transactions, as well as everything that's happening inside of Arch that's not necessarily indexed by Ordscan or another UTXO-based block explorer. So that's one of the major advantages of developers implementing into Arch, is that they remove a lot of the complexities and friction-filled types of behaviors away, and they're just participating with the app.
If they can get on board with learning really about this UTXO model, learning Rust, learning how the Arch network works, then it just really opens up the space for them. A really great design space is what you're arguing.
Yeah, exactly. Like the better user experience and the more liquidity that you can bring users, probably the better position you are to win over those customers. So when it comes to a developer or an app or some team that wants to be building an application specifically for the Bitcoin user, they're forced to consider, what does the experience look like for my user after I've chosen to build in whichever stack? So if they chose to build on BitLayer, Bob, Botanix, whatever, there's going to be one user experience. If you're building on Stacks, it's another user experience. And if you're building on Arch, it's a totally different user experience. And we feel like optimizing for a better experience that is more aligned with that end customer is really going to allow the application developers to win long term.
Yeah. So I want to get into the final part of what I think a lot of people are always curious about, which is, how does an investor think about Arch Network getting, let's say, exposure to it? Maybe if it's going down the path of becoming very successful, what would the average investor be able to do to, maybe benefit from some of its success? Is it building an apps? Is it being early adopters of those apps? Is it, or is it something else?
So we definitely reward early adopters, of course. In our tokenomic plan design, there's a big consideration that's given to users who are participating in the testnet and participating early in the ecosystem. There's a few different ways that their points, air quotes, their points are impacted by this. We'll have what's called the Archtronaut program for both the testnet and mainnet incentivized periods. And as you get more XP experience points by doing both off-chain and on-chain things, your Archtronaut ranks up in status. So you start with the cadet level, and you keep on navigating through engineer or mission specialist all the way up to what is it? Galactic Overlord is like the final stage that you can achieve.
That sounds evil. I'm just going to put it out there.
Yeah. I think that, people that own a certain amount of assets can be kind of perceived that way, like undoxed and little shady maybe, that it seems, because they have such big Bitcoin wallets or Ordinal wallets. How did they get all those node monks and, that sort of thing? So maybe the Galactic Overlord is a little fitting in that sense. But,
yeah, that's right.
But in any case, though, like generally speaking, like we want to drive as much support and activity to the developers and the applications who are launched on Arch. So a lot of the incentives, a lot of the points that you're going to be able to gain is really related around how you go and support those dApps. So
yeah, I wanted to, sorry again, I want to break in here. You mentioned a token design. I guess I want to bring it back because I don't think I mentioned that before. Can you just, are these points? Is this another token that's needed to use the Arch network? How does this fit in? Is this an incentive program? How does this fit into your design?
Yeah, so loosely speaking, I'll say that the general purpose of the token that will eventually be released is really for incentivizing the validator network through gas fees, emissions, and they'll end up using those tokens to stake economic security into the network. So typical proof of stake, delegated proof of stake consensus design like Ethereum, like Solana. And during this initial phase, bootstrapping both the ecosystem, the validator network, the dApps, we have a number of incentives that allow us to align with these more long-term aligned users. So for the users that want to support the apps and try things out and what programmability in DeFi will look like on Arch, like there will be some incentives that will eventually come by way of an airdrop, later down the line. And then also for developers who are looking to build and also need resources to be successful, like paying developers or operational costs and that nature. We also have incentives for those developers, much like the gold program that lasted to reward, the top apps and programs that were built on Blast Network. So we're taking a very similar approach where we, take a big portion of our overall, token allocation, and we figure out ways to align with long-term, valuable users and developers who are going to help grow this ecosystem. So your initial question was, how can, users invest? The first opportunity is going to be by just earning an airdrop, number one. So farm that. And the testnet, there's no real money at stake. It's only testnet Bitcoin. So the only thing that you're risking is your time, to just get exposure to the ecosystem, number one. When mainnet is rolled out, then there's going to be another opportunity to, keep packing your bags for the airdrop. But then there's also going to be this auction mechanism that will likely follow testnet and happen before mainnet, where users who are long-term aligned with Arch and want to support the ecosystem and want to actually get some exposure to the token long-term, they can participate in this whitelisted auction. And that also feeds into the incentive mechanism, depending on what your rank is in the Arch program. So that will be an opportunity to participate. And then, of course, there will be a TGE sometime in Q1 of next year, most likely.
So you just mentioned mainnet, testnet. Can you just map out what that looks like in terms of launch plans?
Yep. Yeah, so testnet will kick off next week. I don't know when this is going to go live. So today's October 2nd. So at about a week's time, we'll launch the dashboard for participating in the first wave of apps that will be launched on the Arch Network testnet. So that's time cadence there. We'll do that program for about a month and a half to 2 months, running us into late November, December, which that is when we'll do the auction and the mainnet launch. So you'll be able to play with actual real DeFi on Bitcoin this year without necessarily any upgrades needed into the stack. Where product is virtually all the way there. We're just finishing up some proof of stake stuff, and we'll be ready to go.
Awesome. And I guess I keep on saying final question, but this really is the last one, I think, to wrap it up. What are your thoughts on this bull run, and where do you expect it to go? What role will Arch Network play within it?
I think I've been fairly outspoken with some of the aligned words bags holders that are just wondering when Arch, and we've been saying we're gonna save everybody's bags. So that's definitely something that I think that we're going to be able to help with. Number one being, like, I think the major thing that's holding fungible tokens, and even ordinals for that matter, but a little less so, is the lack of liquidity that exists for DeFi. A peer-to-peer order book is not how DeFi is essentially scaled. Like, if you go to Ethereum and you talk about a peer-to-peer order book, I think that is relatively more foreign than the opposite, which is more of this liquidity pool style of trading and then swapping. And I think that is going to bring a lot of liquidity in for fungible tokens on Bitcoin, being able to offer this sort of decentralized multi-sig. Liquidity providers can provide that liquidity so that users can lock up to that DEX, and while still self-custodying their assets, they can swap against the liquidity of that DEX. And that's a very powerful dynamic for fungible tokens on Bitcoin, when the other option is just more peer-to-peer order books. So when we unlock these liquidity pools for more traditional DeFi on Bitcoin, I think that you're going to see quite a bit of activity and price appreciation, not financial advice, with some of these more fungible token standards that have in the short history have been quite underwhelming, I think. Like everyone's very excited for runes to come out this summer, thinking that it was going to just take off right from the get-go. And, it's been challenging for people that went deep on runes because there just isn't that type of pool liquidity that should exist for fungible tokens. And when that happens, I think a lot of backs will be saved. So in terms of Bitcoin in general, I do think that, with regards to this election cycle, I think that historically speaking, we always get a little bit of a bump going into an election. Right now, you have a lot of uncertainty, and following the election, there's going to be a little bit more certainty. Market doesn't like uncertainty. Even if Harris gets elected, I think that you're still going to see Bitcoin go up, probably a little bit more up if Trump gets elected. But I think going into the later parts of Q4, we should see a bit of a bull run here. And then if we can coincide that with more DeFi on Bitcoin, I think that that's only going to make it a more bullish case.
Absolutely love it. Matt, where can people find you? Where's the best place to find out about Arch?
So obviously we're very active on Twitter. So Arch NTWRK is our handle. So go follow us there. We're going to be putting out a lot of updates and comms that will help people kind of get prepared for some of this testnet incentivized period. If you haven't seen our white paper yet, there's a link there on our pin to our Twitter page, as well as if you go to our website, arch.network, full spelled network, not the abbreviation. And there's a couple of forms. If you're a developer, fill out a developer form to, get a little bit more hands-on support from our DevRel team. And also get more insights into the incentives that will be available to you as developer for coming and participating in the test and mainnet launch. So lots of unpack as a both user and developer. So follow the channels, go to our website, and subscribe to all the different things that we have going on. And it'll definitely be worthwhile, I think, come February or March next year.
Well, thank you, Matt. And I do want to point out to everyone who's listening, I did read the white paper and the documentation online before this interview in preparation. I have to say it's one of the best I've read just in terms of understanding and readability. It's just fantastic. So it's worth it, especially when you think about the future of what this could unlock for Bitcoin. So Matt, thank you so much for coming on here. I look forward to bringing you back at some point in the future. We can discuss everything that's happened on the Arch network and what it's been able to accomplish.
Appreciate it. I'm looking forward to it.
All right. Thanks. You have a good one.